What's up everybody, Nate here. So the housing market boom in the United States has officially ended as the CEO of Redfin just said that housing prices are starting to fall at their sharpest and fastest rate since 2006, just before the great housing market crash of '08.
It's happening.
And now the big question is, why exactly are housing prices starting to fall so sharply in 2022? Well, you're probably thinking it has a lot to do with homebuyer demand, and you would definitely be right. Homebuyer demand has hit a 2-decade low as interest rates are getting way too high. This means that many Americans simply can't afford to get a home because their mortgage payments are now hundreds of extra dollars every single month. So that bars millions of people out of the housing market. I believe interest rates for a 30-year fixed mortgage are now well over 7%. So with those going up, homebuyer demand comes down, and with demand going down, prices follow suit. But there's actually something much bigger going on here. Regular everyday Americans buying homes is one side of the housing market, right? That is a big portion of it, but something that is not really being talked a lot about right now is the investor side. And right now we're seeing investors pull out of real estate deals at a faster rate than we have pretty much ever seen. So what exactly is going on here? Well, over the last couple of years, we have seen so many real estate investors and real estate investing firms enter the housing market. Really low interest rates, a lot of government stimulus, and just a lot of money circulating throughout the economy made all of these real estate investments basically irresistible for real estate investors. I'm talking people that are going to be renting out these homes or flipping them or just buying something that they can eventually sell later through appreciation. I mean, if you were to buy a house in 2020, you would now have instant equity in that home because the entire housing market has been exploding. So lots of real estate investors entered the market because it was a really easy sale, and in just about every major market, we saw real estate investing firms and investors blow up all of those areas. They were starting to buy more and more houses, but what that ultimately did was sort of drive up everything in the housing market. So with fewer homes on the market for people to buy, now they have to go out and rent them, and if regular everyday Americans are renting more homes, that means there's fewer rental properties on the market with fewer houses. So rents go up, and also mortgages and housing prices also start to rise. A record 40% of the housing market in 2021 was fueled by real estate investors. So that means we have a huge portion of the housing market that is being dominated by real estate investors. Now, if the housing market is really strong, if people have jobs and people are able to pay their rent and their mortgages, and the rest of the homes around these real estate properties are also starting to gain value, this is still a no-brainer for your real estate investors. They're going to want to hold on to those properties because to them, the values are going to go up and they're continuing to rise, which means more money for them and more cash flow. But what we're starting to see in 2022 is a complete reversal of what happened over the last couple of years. Now, housing prices are going down, and the reason they're going down is because of really high interest rates and buyer demand. But what that is doing is causing these real estate investment properties to also lose some value. Now, the first and foremost thing you've got to understand here about real estate investors is that they are in it for a profit, right? These real estate investors buy these properties to rent them out or to flip them or to gain appreciation on them. But at the end of the day, they are trying to get some sort of cash value from them, whether that's cash flow or whether that's a bulk payment at the end of 5 years or 10 years. They want to make money. So the second that these real estate investors are starting to lose money on their properties, now they want to get out.
We need to leave now.
So how do real estate investors play into the larger housing market in 2022? Well, they are starting to sell these real estate investments, or they're starting to lower their costs for them so that way they can still make some profit this year. Because they're seeing housing appreciation values drop by around 1 to 2% in the United States on average, that means they're kind of starting to see the writing on the wall. And before things start to get really bad in the United States, these real estate investors want to get out. They want to try to make some sort of profit on this property while they can before it starts to lose value and they become underwater on their mortgage. And now it doesn't really make a whole lot of sense to sell their property. They're going to want to hold on to it at that point. These real estate investing firms, they have a lot of money, and they have a lot of money that's tied up in a variety of different funds. And physical real estate is one of their biggest investments, but they have other investments too, and they need to hold on to real estate and these houses and these rental properties as long as they can in order to fund their other investments. So if they start to see that these assets that they're holding on to are starting to lose them value, then they can't hold on to them anymore because now they're going to cost them money, which really isn't an investment at the end of the day. And how this kind of creates a unique problem for the housing market and how it could even send prices lower into 2023 is because over the last couple of years, investors, well, they got really good deals to go out and buy real estate investment properties because a lot of these real estate investors and investing firms own hundreds, if not thousands, of different properties. That means they have a little bit more skin in the game, and because they have a lot more assets, these banks that are going to give them a mortgage to buy more properties are going to give them a really favorable mortgage. Because they have so many assets, they could essentially sell those assets to pay for something else. So the mortgage that they're going to get is a whole lot lower than what your average American is going to get, because the average American doesn't have hundreds of thousands, if not millions of dollars worth of assets. So because these real estate investors got such a good deal on their homes, that means, well, we now have a lot of real estate properties all throughout the United States. And if the vast majority of them start to lose money because the larger housing market is starting to become devalued, well, now you're going to see 30 and 40% of the homes on the market suddenly become for sale. Obviously, not every single real estate investor is going to sell their property, right? We're still seeing some areas in the country that are seeing some price increases for homes. So that's a good situation for the real estate investors. And that means that inventory really isn't going to rise that much in those areas. But there are also a large portion of areas throughout the United States that are starting to see price reductions and are starting to see real estate investors get out of these deals. And that means that inventory is about to really jump in the United States. Now, if you kind of couple that with the other side of the housing market, that is the regular American looking for a single family home, well, that's where things really start to get complicated in the United States. And that is exactly why prices are falling sharply, the sharpest they have since 2006. You see, many of the Americans that own homes right now lived through the 2008 Great Recession and the housing market collapse. So they now kind of have an idea of how the housing market is supposed to function. Before 2007 and 2008, many generations basically told people that a house was an investment. And the reason for that is because in their entire lifetime, housing prices only went up. But an entire generation of people found out in 2008 that there could be situations that cause the housing market to actually go down and lose a lot of its value. So there are a lot of Americans right now that currently own homes, but they're scared of what could be coming next, which could push them into selling. And we're starting to see that in certain markets throughout the United States. Some of them are close to selling. Some of them don't really know what's going to happen with our economy. And some of them just don't even want to sell their house, but they feel like they should because this is their last chance to get something for their house before prices really start to decrease. Now you have multiple generations who lived through this 2008 crash, and they know that housing prices do not always go up forever. There's a chance that they could go down, and that means they might want to sell. Now, what we're kind of leaning towards is more inventory to come on the market, and that is exactly what the Federal Reserve wants by raising their interest rates. They want supply to catch up to what demand is. But prices might start to accelerate and actually dip even further if demand continues to come down and supply continues to increase. If you have a bunch of real estate investors that are starting to sell their homes because liquidity is short in their market and they want to make a profit on these homes at the end of the day and are kind of seeing the writing on the wall that prices might start coming down even further, then they're going to want to sell. And now you have millions of homes entering the market right away. But on the opposite side, you have home sellers that know their home might be at its peak value right now. And if they don't sell it, they're going to be stuck in their home, a home that they might not be able to afford a couple years down the road if we go into an economic recession and we see a lot of jobs lost. So now they want to sell, but the big issue is prices are still way too high in the housing market. Meanwhile, mortgage interest rates are also way too high. That means we could have a situation in 2023 where inventory is almost starting to outpace what demand is, and that means that prices are going to come down even further. And this is a situation that is basically the writing on the wall for the housing market, because the housing market is not as stable as a lot of other generations thought it may be. That is basically an outdated way to look at the housing market. No market, and I mean no market, can go up forever. Eventually, you're going to see dips. And right now, we might see one of the biggest dips in American history because of how inflated the housing market has become over the last 2 years. If you look at the stock market, market, for instance, it set a record high at the end of 2021. All of these stock prices exploded because of lots of liquidity and really low interest rates, and of course, quantitative easing by the Federal Reserve. There was no reason why it wouldn't go up and up and up forever. But now that all of that demand is sucked out of the stock market, it has basically erased all of its gains over the last 2 years. It has completely reset, going right back to where it was just before the pandemic and all of this money printing and low interest rate environment. The same thing for the cryptocurrency market. You could get one Bitcoin for around $65,000 as of November last year, but now Bitcoin is barely hovering around the $20,000 mark. And the same thing might be coming for the housing market because all of these values are way too inflated. So all of your housing prices need to come back down to a place where Americans can afford them again. And that's going to take some time, but it could mean we could see values drop 20, 30, and 40% in the United States. The sharpest drop we have pretty much ever seen. And that is leading to a complete housing market reset. These prices need to come down significantly so that regular everyday Americans can buy a home, and for it to make sense for a real estate investor to also start purchasing properties. And things are only going to continue to get accelerated as the Federal Reserve raises its interest rates, which means this housing market dip that we're seeing right now could just be the start. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.